There's a tax classification the IRS created in 1986 that allows real estate investors to deduct unlimited losses from rental properties directly against their W-2 salary, their business income, and every other dollar they earn. Not the standard $25,000 deduction that most taxpayers are limited to. Unlimited, a doctor earning $4,000 a year can legally reduce her taxable income to nearly zero using paper losses from rental properties she has never physically visited. The IRS wrote this rule. Congress passed it into federal law, and for nearly 40 years, the wealthiest 1% of American earners have used it every April, while 99% of taxpayers have never heard its name. It is called real estate professional status, 3 words buried inside Section 469 of the Internal Revenue Code. Understanding them is the difference between writing the IRS a check for $100,000 and writing them a check for zero. In 1986, Congress passed the Tax Reform Act to close abusive tax shelters. Before 1986, a Wall Street executive could invest $5,000 into a real estate partnership, receive $2,000 in paper depreciation losses, and use those losses to eliminate taxes on his entire salary. The IRS was losing billions. So Congress created the passive activity loss rules under Section 469. If you do not materially participate in an activity, the losses are passive and can only offset other passive income. For 99% of Americans who own rental property, this means losses are trapped. You can only deduct $25,000 in rental losses per year, and that phases out completely once your income exceeds $15,000. For high earners, the rental deduction is effectively zero. But Congress left one door wide open. The real estate industry spent millions lobbying to make sure it stayed open. Then someone in the accounting industry realized what they had: a classification that turned every dollar of depreciation into a weapon against the IRS. And they made absolutely sure only their highest paying clients would ever learn how to use it. They did not hide it because it is illegal. They kept it quiet because it is devastatingly legal. This is the story of real estate professional status. The tax classification the 1% activates every year and that your accountant has never once mentioned. Welcome to Channel. If these stories matter to you, hit subscribe and the bell. This is where we open the files the fine print was designed to bury. Now let me take you back to where this rule was born and why Congress left it open on purpose. The Tax Reform Act of 1986 was the most sweeping overhaul of the American tax code in decades. President Reagan signed it on October 22, 1986. The primary goal was eliminating abusive shelters, and for most Americans, it worked. The passive activity loss rules effectively locked rental real estate losses behind a wall ordinary taxpayers could not climb. But the real estate industry was the single largest lobbying force on Capitol Hill during the mid-1980s. The National Association of Realtors, the National Association of Home Builders, and dozens of development firms argued that locking away all real estate losses would devastate the housing market. Congress agreed and carved out an exception. If a taxpayer qualifies as a real estate professional, their rental activities are no longer passive. They become active. And active losses can offset any income from any source without limit. The exception was written for full-time real estate developers and agents, but the language does not say developer or agent. It says real estate professional. And the IRS defined that term with 2 simple tests that almost anyone can meet with proper planning. Test 1. You must spend more than 750 hours per year in real estate activities. That is roughly 14 hours per week. Test 2. More than half of your total working hours must be in real estate. If you work 2,000 hours total, at least 1,000 must be in real estate activities. 2 tests, no license required, no degree, no minimum number of properties, no minimum revenue. Meet those 2 hourly thresholds and every rental property you own switches from passive to active. Before I go further, everything I have revealed barely scratches the surface of what has been hidden from ordinary taxpayers. I spent months gathering the tax strategies, the legal structures, and the financial defense techniques that the top 1% use, and that the accounting industry reserves for premium clients. All of it is inside the complete vault. The REPS qualification checklist with exact hour logging templates, the Spendthrift Trust blueprint, the debt validation letter, the Homestead Protection Guide. Over 10 guides in one vault. No filler. Every page built for immediate action. The link is in the description right now. But stay here because the math behind this status is about to make your accountant very uncomfortable. Here is why this classification is so powerful. The IRS allows property owners to deduct depreciation on residential rental buildings over 5 years. On a $300,000 rental property, the building portion might be worth $25,000. That generates $990 per year in depreciation. A paper loss, you did not spend that money. Your building did not actually lose value. But the IRS treats it as a deductible expense every single year. For a normal taxpayer, that $990 is trapped as a passive loss. It can only offset passive income from other rentals. If you have no passive income, it carries forward doing nothing. But for a qualified real estate professional, that $90 is an active loss that offsets your W-2 salary, your business income, your capital gains, everything. Multiply that across 5 properties, 10 properties. Add a cost segregation study that accelerates depreciation on components like appliances, cabinetry, and landscaping into 5 to 15-year schedules instead of 27. 5. Suddenly, a portfolio generates $8,000 or $500,000 in annual paper losses. A taxpayer earning $3,000 with $1,000 in accelerated depreciation pays taxes on $2,000 at a 32% marginal rate that is $32,000 saved in 1 year, every year. Legally, the courts have upheld this repeatedly. In the 2014 tax court case, Hassanin versus Commissioner, the court ruled that a taxpayer who documented 750 hours of real estate activity qualified for REPS, even though she also held a part-time W-2 job. Documentation was key. Hours logged contemporaneously with date activity and time spent is the standard the IRS accepts during audit. If you have made it this far, you already know more about legal tax reduction than 99% of Americans filing returns this April. Subscribe and share this with someone overpaying the IRS by tens of thousands because their accountant never mentioned 3 words. Everything the accounting industry reserves for premium clients is inside the vault. Link in the description. Now stay with me because this is exactly how to use it. Step 1. Determine if you or your spouse can meet the 2 tests. 750 hours in real estate activities and more than 50% of total working hours. If one spouse works a demanding W-2 job, the other spouse can qualify independently. The IRS allows married couples filing jointly to use one spouse's RPS qualification to unlock deductions on jointly owned properties. Step 2. Understand what counts as real estate activity. Property management, tenant screening, lease negotiations, bookkeeping research, driving to properties, and any activity directly related to your real estate business. Travel time counts, education counts. Step 3. Log every hour contemporaneously. Record activities as they happen, not at tax time. Use a spreadsheet, a dedicated app, or a notebook. Date, activity description, and hours. This log is your only defense in an audit. Step 4. File an election to aggregate all rental activities by attaching a statement to your return. Without this, the IRS treats each property separately. Step 5. Hire a CPA who specializes in real estate taxation. The fee runs $1,000 to $3,000 per year. Compare that to the $3,000 or more in annual savings this classification generates. Now, I need to be completely honest with you about the limitations, because people get audited every year for misapplying this. The 750-hour requirement is real, and the IRS audits it aggressively. If you work a full-time W-2 job at 2,000 hours per year, you personally cannot qualify because real estate must exceed half your total hours. However, your spouse can qualify even with 0 properties in their name if you file jointly. RPS does not eliminate taxes permanently. It defers them. When you sell depreciation, recapture hits at 25%. You can avoid recapture through a 1031 exchange or by holding until death when the cost basis steps up. Cost segregation studies run $3,000 to $8,000 per property. On smaller properties, the cost may not justify the benefit. If you claim reps and cannot prove it during audit, the IRS reclassifies all deductions as passive, disallows them retroactively, and assesses penalties plus interest. The tax preparation industry generates over $14 billion annually. The vast majority comes from ordinary taxpayers filing standard returns. A client who qualifies for reps and saves $3,000 per year does not need a standard preparer. The standard industry has no incentive to tell you that 3 words on your return could change everything. Your accountant is not hiding this maliciously. Most general CPAs do not understand RPS rules well enough to implement them. Real estate tax strategy is a specialization within a specialization, serving high net worth clients exclusively. Not because the law requires wealth, because the industry charges accordingly. Congress wrote this rule in 1986. The IRS published the regulations. The tax court has upheld it case after case. The law is on the books. The qualification tests are public. The forms are free. The only thing standing between you and tens of thousands in legal savings is the fact that nobody who profits from your tax bill has any reason to tell you about it. If this vault changed how you see the return you filed last April, subscribe and share this video now. Every share arms someone with knowledge the accounting industry has reserved for its wealthiest clients for nearly 40 years. The next vault opens soon, and what is inside could protect the one asset you cannot afford to lose. Court acquis.